All right. Blake Janover here. I've got Aleksey Chernobelskiy. I hope I didn't screw up the name. With me is still 99 percentile.
Still 99 percentile, yeah.
So Aleksey ran Store Capital's $10 billion commercial real estate portfolio. He ran their underwriting. This is off the top of my head. Quadruple major in finance, mathematics, accounting, and something else nerdy.
Economics.
Economics. I love economics, so
Yeah.
maybe we'll
Yeah.
go there. And you did some stuff at HBS. You did some stuff at Yale. You're on a board, underserved children, mathematics and science. You're just you may as well have a cape. Did I touch on all the stuff?
It's a pretty good summary. Mine is the cape. Oh, but yeah.
All right. I think that's as good as this podcast is going to get. So maybe we should just call it now. I think we hit on.
Yeah, it was
I
great. Thanks for having me on.
that pleasure's mine. We're going to send this to a few 100,000 people. I don't know if anybody's going to watch or listen, but let's pretend like they're going to. Um,
Sounds good.
so true to my, we'll call it style. Let's just let's be. You and I are not prepared. We don't have any questions. You don't know what I'm going to ask. I don't know what I'm going to ask. We're winging it.
No clue. Let's do it.
All right, cool.
I'm ready.
So tell whoever's watching and listening what you do.
Yeah, I mean, so I'm just an independent LP advisor, which is a fancy way of saying I'm not compensated by GPs. I'm only compensated by LPs, so limited partners, i.e., like passive investors in mostly real estate deals, although I've advised on VC, oil and gas, all types of other stuff. So more broadly, like alternative investments. Um, I spend a lot of my time on future deals. So in other words, like an LP will ask me, "Hey, what do you think about this deal?" And I'll give them feedback so that they have an independent source to sort of think about questions. And then I also advise, particularly now in the past like 6 months, has been pretty busy on the existing LP position side, where there's a lot of capital calls. Some are better than others, and so I try to help the LP decipher between the good and the bad, so to speak.
So we'll talk real estate because that's we have like an over we have like an intersect there. So when you're looking at the deal to determine should I make a capital call, should I not make a capital call, and you're trying to make it objective and remove emotion, what are you looking at? Are you just looking at like, hey, this GP is modeling for a 3.5% exit cap. Please don't do that deal. Or are there other things that you're seeing under the hood, once you lift it?
Yeah, so I actually it's funny that you asked me this today. Yesterday I published an article called Minimum Viable Capital Call. And the entire purpose of the article was I kept seeing a bunch of capital calls that just didn't give enough information for an LP to make a decision. And so there's sort of like bells and whistles that you could have in a capital call, but like forget about those. What are the basics? Like what's the foundation that you need to provide to an LP for them to be able to make a decision? And so to your point, there's some things in the decision that are like, what are you planning to sell the property at in the future? What's the exit cap rate? What's the plan in terms of the viability and the projection of cash flows, right? But there's like a lot more basic things that I usually see that are totally missing. For example, what happens if I don't invest? In other words, like, do I get diluted? Is this new instrument that you're putting in, for example, like, is this just a common equity raise, or is this a note that's going to be senior to my equity in case in the event of the waterfall, right? When the sale occurs. Um, um, and so like that very simple thing is oftentimes not discussed. From the side of the LP, um, I mean, I've had numerous cases of LPs calling me and saying, "Hey, like I have this capital call. Should I do it?" And my first question is always, "Do you have the money?" And sometimes the answer is, "Well, yeah, like I mean, I have my 401k, like I can pull on it." And I'm like, "Whoa, like way more complicated all of a sudden, right? Because like if you borrow for a 401k, you have to return that money back with an interest rate, right? To avoid penalties. And on top of that, like, and some people have said like, I'll ask my parents for a loan or whatever, which is above my pay grade. But my point is, there's like some very basic things you need to know, right? With the other thing being just like what's the status of the property today, right? So like what's the capital stack? Are there any other loans that you took out, which is not unpopular, I'll say, nowadays. Sometimes without the consent, not I shouldn't say without the consent of the LPs, but like without LPs knowing, right? LPs don't have consent rights usually to like additional indebtedness, but they will. I mean, I would argue they should know about it, even if it happened, right? Um, so yeah, like what's the position of the property today, right? And what are our options on the table?
You know, it's you
I
know how
can
when you
keep going.
no, 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 I know, I know you can. I want you to. I just I want to feel smart. So I'm going to interject. It's not going to be helpful, and then you can get back to saying what you're saying. But it's watch this. It's like you know how you get a new app through Apple, and you're clicking and accepting all the terms. It's like it's time for everybody to go back to the operating agreement that they originally signed to see what exactly they signed on for, and perhaps what rights they have and what a capital call actually looks like, because all of that's
Yep.
documented in the initial OA that nobody read. Um,
Yeah. Although I
I,
would say, Blake, I would say the the agreements, generally speaking, are actually super vague from what I've seen. And I think part of that is intentional because like you don't really know what's going to happen and you want the GP to have wiggle room, so to speak, as to how to respond to like an emergency.
mm,
Um, there's downsides to that though too. Like it doesn't say what you need to disclose in the event of a capital call. It doesn't say that you need to give I'm just saying generally speaking, right? Like some, of course, some operating agreements are more advanced and they have these, but like it doesn't say, for example, if you're allowed to give a capital call, if there is a decent chance that none of the money gets returned, which is a whole other topic we can talk about for 30 minutes, where there's like a misalignment between GPs and LPs in the event of like deep distress. A GP sort of um naturally I'm ignoring ethics for a second because hopefully ethics kind of pull people up from this, but if you ignore them, um if you're about to default on something and you have like other properties that you're raising money on, or you want loans on other properties and you don't want lenders to know about those, you're impeding foreclosure. So your immediate incentive, ignoring ethics, is hey, like I just need to keep this thing afloat. Like, who cares, so to speak, what happens to it, right? I just need to keep it afloat. And so I'm going to send this capital call email. From the LP perspective, all you care about is I'm fine doing the capital call, but is this the best path to making the most money out of what I originally invested? In other words, maybe it's better to fire sell this thing today and get 70 cents on the dollar than risk making 70 cents 5 years from now with all these assumptions,
I think
right?
so. Just to interrupt you, as I'll do from time to time. There's definitely the sunk cost thing that's happening as
Yeah.
LPs. I also think it's kind of um, uh, optimistic in some cases about 70 cents. I think I've
Oh,
seen a
yeah.
lot where it's just and the LP is getting wiped.
Yeah.
I think there's a lot of that out there. So you mentioned the GP in a few places, So I want to touch on it for a second because we're going to talk about LPs. But as a GP, you know, what do you do? We're getting to the tail end of the year, right? And we'll say something that's not evergreen here. I think Powell got up and was like, "Hey, I'm dovish now, right? We have to start thinking about
Yeah.
lowering interest rates." And the idea being that the behavior of the Fed will influence 10-year treasuries. 10-year treasury yields will come in. They come in. It'll improve. It'll reduce cap rates. It'll improve liquidity in the market. It'll put banks in a better position. Blah blah blah. Hopefully, like has some positive impact on
Yep.
income producing commercial real estate, right? That creates like long-term revenue streams. As a GP, assuming I'm an ethical GP, what do I do? I can make a capital call. We're getting to the end of the year. I can make a capital call, and the deal might not be great right now, but I believe that in 2-3 years with a new loan, we're going to be better than ever. But right now, maybe
Yeah.
we're upside down, or maybe we're tapped out. What do I do? Do I take the L? Do I push the deal? Do I make the capital call? How would you think about this if you were the GP?
Yeah, totally. I mean, I think the way I would think about it is just be ethical and transparent. That's it. In other words, Blake, like, um, let the LP decide whether your assumptions are realistic or not, but be transparent about them. In other words, if you want to assume that in 2, 3 years you're going to be able to refi at a 4% interest rate because of Powell lowering rates again, that's fine. Like, meaning there's no issue with you making any assumption. Just as I generally say, like, for example, if an LP is looking at a new deal and it has like massive cap rate compression as an assumption, I have no problem with that. Like, I mean, I have opinions on it, and I
Right,
think it's sort of a macro bet rather than a property bet,
right.
right? But as long as you know that going in, and you've sensitized the fact that that might not happen, and you're comfortable with it, no problem. You should just know about it and not hide it. You're right. Don't hide behind the assumptions.
So reading between the lines, what I'm hearing you say is that like one of the big differentiators between a good GP and a bad GP is honesty and over communication. If you'd expand on that a little bit, so for me, one of the biggest differentiators between a good deal and a bad deal, or maybe the biggest, is a GP. You can give me 50 assumptions, and I'll take the deal where all the assumptions look um, so with an all-star GP that's aligned, right? Uh versus a GP that might be an unknown or something like that. How does an LP investor kind of differentiate between, and do you agree? Do you agree that like the biggest single factor in a deal is the GP? Because and if you do agree, and if you don't agree, like share it. How
Yeah.
does an LP tell how good a GP is?
Yeah. So, in short, I agree that it's the biggest. I would also say, and I think you would agree also, that it's not the only, right? In other words, what I've written is I basically authored, like, let's call it a methodology of thinking about LP investments, and there's three pillars. The first one is the GP's ability to execute, and there's sort of like trustworthiness in the marketplace, and let's define that as, like, not having any crazy lawsuits that wouldn't be normal for a GP, et cetera, right?
That's a low bar.
Uh, as it should be. Like, for example, they haven't been, convicted of like issues with the SEC or something. I don't know. Like, you
Sure.
don't usually find that, but sometimes you do, right? And not to say that, people can't change, but like that's a whole other discussion. So that's really the first pillar is like, does the GP have the experience and sort of like the brand, so to speak, as someone who will be able to execute and is trustworthy. That's the first one. The second one is alignment between the GP and the LP, which like is, I think, in my opinion, way more important than most people make it seem. Um, that has to do with the co-invest, especially its relation with the acquisition fee. It talks about the fees, fee structure in general, both on like on the front end, the back end, during the duration of the investment. And the third thing there is just the waterfall, meaning like, is there a return of capital clause? You'd be shocked to know, like, sometimes it's missing. Um, and oh, by the way, like, what's the split? And is there a pref? Et cetera, right? So that's the second pillar. So like, how is the GP and LP aligned appropriately uh, at the set out of the deal, or the start of the deal, I guess. Um, and then the third one is the property itself, which might surprise people. Like, some people come back to me and they're like, "You're crazy! Like, I'm I'm giving you an LP investment to review, and the last thing you look at is the property itself." And I'm like, "Yeah," and I'll defend that. Yeah,
Yeah.
meaning, if you were to ask me to look at a deal as a GP, then that's different, right? Because there, Like you're basically focused on the property itself, right? But as an LP, you're investing in something that's illiquid. I don't really care how nice the person is. At the end of the day, like they need to have the experience to like run through this project and they need to know what they're doing. And by the way, it's okay if they don't know what they're doing. Everyone needs to start somewhere, but you need to be aware of that and hopefully be compensated for that additional risk, right? So in short, I know I said a lot, but in short, like I agree that the GP's track record and sort of trustworthiness comes first. Um, and somewhat surprising, I think the property, I mean, I spend a lot of time on it, don't get me wrong, but in my analysis, I sometimes don't even get to the property. You know,
Sure.
like I sometimes I find so many issues with one and two that once you get to three, it's like I don't even know like what these financial consist of. Like meaning at some point you start losing trust early on in this process to where like once you get to the financials, and remember, you don't have the actual rent roll, you just have a deck,
Yeah.
right? And so sometimes you get to the pro forma and you're like, yeah, like I don't know if you can double these rents.
Right.
You know what I mean?
So,
Like
but yeah, so just to present like, so I've thought about this, right? So for me, it's I see a curious case of kind of, I don't want, it's not adverse selection. I'm trying to think what's the right cognitive bias, but hear me out. I think the number two pillar, which is alignment, is the biggest, most important thing, right? Like GP says they have skin in the game. They co-invest, 5% of the LP, but they get, a 2% acquisition fee, a 1% refinance fee, a 3% asset management fee, whatever. So this is like a fundamental, misalignment. But hear me out. So I made some investments with super aligned GPs that were kind of novice, right? They were, it's been
Mhm.
their first deals. So they're invested in the LP. They put a HELOC on their house. They don't take any asset management fee, no acquisition fee, no refi fee, right? They're all in. And I've had very outsized outcomes here and trash. And on the other side, I've seen deals that look great from GPs that look great, but because they're great, they don't have to do any of those things anymore. So you can get a fabulous GP with the best track record, who's high integrity, who doesn't need my money, and he's not co-investing a dime because the economics on the GP side are much better anyway, and he's getting an acquisition fee and he's getting an asset management fee. So how do you think
Yep.
about that, Aleksey? How do you think through that?
Yeah, I mean, I think it's important for LPs to remember that this is just a marketplace, right? In other words, there's like demand and supply. Um, the demand, so to speak, is the LPs lining up to invest in something, right? And the supply is the number of deals that are raising for money. And so what you're describing is is actually pretty normal if you think about it. Like, I mean, one example I gave in I wrote an article almost a year ago called "Top 15 Syndication Mistakes," which is basically like a synopsis of all the things that you could have seen in deals that end up going bad. Um, and one of the things that I noted in there as a disclaimer is like, for example, one of the things they said is fees, acquisition fees over 3%. Uh, I don't call things a red flag. That's sort of another discussion maybe, but
Mm.
it's above 3% should cause you to stop and think. That's what I called it, right? And so um I caveat all that though with the fact that like there's a marketplace. And for example, it's an extreme example, but there's a hedge fund called Renaissance Technologies. They're infamous for like charging insane fees. And yet there's like people lining up to invest. Go ahead.
I'm going to comment. So Renaissance closed their doors to outside investors a long time ago, and those GP fees that they were charging, I think, were really feeding the next generation inside Renaissance. That's a unique animal, the Renaissance, the
Yeah,
RenTech
yeah, yeah.
deal.
But my point, and there's other examples in the hedge fund industry. There's other examples in the
Sure.
GP, like a real estate space. My point is that like at some point, A GP may decide, like, look, I only have so many deals that I buy per year. They might decide I only want to buy one deal a year.
Yeah.
And guess what? Like, if I send this deal to my list of investors, which trust me, I'm gonna get it oversubscribed in 5 minutes. And so therefore, to some degree, I can charge whatever I want.
Absolutely.
And to your point, I might not co-invest, right?
Yeah.
And this is the hard part, Blake, is like an LP calls me and they're like, I don't understand. Like, why is there no co-invest? Or why is the co-invest so much smaller than the acquisition fee in dollar terms? And the only answer to that is like, because they can,
Right.
right? There's no answer to that. And the question ultimately for an LP is, are you comfortable with it or not? Right?
Right.
Like meaning
Does
it
their
in the full
experience,
context of the deal.
does the deal, the
Compensate for it.
experience, the track record compensate for that
Yeah,
line? Right. So I
exactly.
agree.
Yeah,
Yeah, yeah.
yeah,
I think
yeah, exactly.
I think it's a very, there's like a lot of these interdependencies here, right? Because
Yeah,
you may check the alignment box and fail in two other places, or fail the alignment box
totally.
but check the other two
Yes,
places. Yeah,
yes.
I agree with that. Um, uh, Pivot for a second, then we come back to LP stuff. And by the way, there's no clock here, so we could be done in 1 minute or an hour. Um, there's some books behind you. I'm blind, but I at least see the intelligent investor, right? I think I do at
Yeah,
least. Okay.
yeah.
Do you have a favorite up there on the shelf or at the
I mean,
bedside?
I like a lot of I like a lot of different kind of books because I it kind of there's a lot to be learned from like different pockets of investing. You know what I'm saying? Um, and I think it's all very applicable to real estate in different ways. Um, I mean, one of the aspects of me being independent, Blake, is I'm able to speak my mind. And sometimes, I don't know, I guess let's call it certain GPs don't like it. Um, I'll give you an example. Like over the past, I remember, I don't know if you recall, but about 2 weeks ago, there was like a bit of a drawdown, right? In the stock market.
Yeah,
And the
the
next
Japan
day,
play, right?
yeah, exactly, exactly. So
Yeah.
and there was like the next day, I don't know, maybe it's just my feed, I have no idea, but on Twitter and LinkedIn, like half the feed was like, hey, look, I told you guys, everyone needs to pull out of the stock market. It has these crazy drawdowns. Real estate is like passive and it's safe. And like you need to invest in real estate now. Schedule a call here. And
Yeah.
that stuff just drives me nuts because it's
Yeah.
like, I don't mind if you make a fair argument for investing in syndications. I think there's enough benefits to it, right? To make a fair argument. But like, guess what? If you want to do a fair comparison, look at REITs. REITs also had a drawdown, right? And
Hold that
that's
hold that
yeah,
thought.
yeah, go ahead.
Hold that
Go
thought.
ahead.
Tell me your favorite books. You got
Oh,
away.
sorry, yeah.
I'm here
It's
to hold
actually
you
like
accountable. This is an accountability
yeah, yeah, I
system.
like it. So like I like Ray Dalio's book.
Okay.
That's here.
Principles. I saw it on the right,
Yeah,
up
principles,
there
yeah.
on the right. Yeah,
I learned a
it's a
lot
good
from
book.
that. I think another one, um, this one, I don't know, it's not like a
Deep
complete
Work.
finance book, but
Carl.
Deep Work, yeah.
Is that Carl
Newport,
Newport? Yeah, that's a good
yeah,
book.
yeah. Big fan. And Never Split the Difference is another one. Um,
Yeah.
I've like, to be honest, in terms of like syndication books,
No, I'm not
I've
talking syndication. You could tell me science
investing.
fiction. There's no
Yeah,
rules
yeah.
here.
Yeah, yeah. I mean, those are. I think if you were to tell me top three, it would probably be those. Um, Psychology of Money. I haven't gotten to read, but it's on my
Oh my
shelf.
God.
But I've
That's
heard.
Morgan Housel, and it's
Yeah, yeah,
fabulous. Doesn't
yeah.
matter.
I follow him on Twitter, and I'm like, I really like a lot of his stuff, so I just haven't gotten to read it yet. But it might become
It,
a favorite.
it's so well written, and he takes such basic concepts and just tells it so well. You could devour it in a couple days. I think I've read it twice. He's
Nice.
like a yummy writer. I don't know how else to describe his writing. It's
Nice.
delicious. I'm jealous.
That's awesome.
All right. Coming back to some GPLP stuff. I wrote a couple notes
Yeah.
down while you were talking. Um, I guess the answer might be the same. So maybe it's not a great question, but how do you, any other suggestions for differentiating a value trap from a big opportunity? So you get the 30% IRR. you're modeling the exit cap. It's a great GP. He's aligned. Any other things or like stand out? Like, hey, did you look at this? Like
Yeah.
anything come to mind?
So I think the biggest trap in the COVID era, let's call it, was exit cap rates,
Yeah,
cap rate compression.
yeah,
I don't see that as much now. I think people have realized that sometimes cap rates change and sometimes that's in the positive direction. Um, the trap that I see now a lot is like refinances. So basically, you're going into a deal, and maybe you're going into it at a seven. You're selling it at a seven in 5 years, but in year three, you're assuming a refi. And you're looking at the deck, and there's like no details. Like it's just like it's a 25% IRR, and like, oh,
yeah.
by the way, we're gonna do a refi, but there's no details. And it's like, well, okay, like what are you assuming on the refi? What's the rough
3% 10 years
LTV?
IO, 90 LTV, 3 years.
Yeah, 90, yeah, exactly. Like, what's the loan to value? Like, what's the NOI at the time of the refi, right? And all these things are just
Yeah,
like sort of like under the rug, so to speak. And once you dig in, like they have like pretty serious assumptions,
yeah.
that are, I mean, again, you can make any assumptions you want, just sensitize them is my
I
humble request.
I think that tell me if I'm wrong. My personal opinion, which is I have unlimited amounts of, is that this is actually the best time uh, in a decade to be an LP. In retrospect, 10 years ago was the best because you had this cap rate compression, right? But if you go back 10 years ago and you're looking forward, it looked pretty scary. Right now, it's pretty interesting. There's deals that are distressed. There's distressed debt. There's office. There's all kinds of things where the value might be mismatched. Like today's price might be mismatched from the long-term intrinsic value of the asset. So I guess my first question is, do you agree with that? Do you agree with that? Is this the best time to be an LP if you're thoughtful, or is this the worst time to be an LP?
um, I think it's a pretty complicated question, Blake. Um, if you were to force me to give an answer, I would probably agree that it's a good time. The reason why I sort of struggle with giving that answer is, I mean, this is just sort of like a function of the place where I sit.
Yeah,
When I say that, some LPs get too excited. And it automatically in their head means any deal that hits my inbox is good.
God
Meaning
no.
any deal, like
Right.
the sample size, my sample size is better than the sample size of someone 10 years ago. And I don't think that's true because that's a very biased sample size. Does that make
Sure.
sense? In other words, like, but people naturally want to make that like want to make that assumption because like if you ask me if you take all the deals that raise money today versus all the deals that raised money in, I don't know, 2019 or something, like, yeah, it's probably a better time across like a really big population. Now, I'm a doctor, software engineer, whatever. I see a random deal pop into my inbox, and it's very easy to just be like, oh, like this is like, yeah, like there's distress and like rates are gonna move down, and this is so good. I should immediately invest before someone else does, and that's where like I start to get nervous because people sort of like tend to take this a little bit too far.
Yeah. Yeah. I look, the sample size is really important. And I think it gets overlooked. And there's like a bit of a selection bias, right? Like if you don't have a track record, if you haven't been in a lot of deals, if you don't have the network, you're less likely to see that better quality deal perhaps than if you have the
Exactly.
network, if you've been doing it for a long
Yep.
time. Um,
Yep.
do you see any interesting, cool, funky structures? I'm sure you see mez, pref, debt. You see any like cool things or creative things that GPs or LPs are doing that's worth sharing a little?
Well, I think it depends how you define cool.
This is, you and me define cool the same way, just so we're clear.
Yeah, no, so to me has cool has a positive connotation. Um, what I'm about to describe to you, I think is more of a negative. Um, but I think it's worthwhile to discuss. I'm curious what you think of it. Um, one, I don't want to call it standard, but one fallback option that some larger GPs have went to is what I would generally categorize as like recapitalizations. In other words, I mean, just for the sake of example, let's say you have 10 deals. And for the sake of example, five are terrible, like equities wiped out more or less, and five are sitting, they were bought in like 2018 or whatever, you just haven't sold them yet. And let's say they're still sitting at like 1.5, 2 times multiple or whatever, if they were to be sold today. And you're sitting there and you're like, man, I really don't want to make a capital call on these five really bad ones. Like, I don't want to upset investors. And sometimes what happens there's numerous ways this can happen. One is through like sort of um, putting debt across all, like cross collateralizing that entire pool.
See
You could
that.
take pref across that entire pool.
Yep.
Some people are looking into like rolling sort of all of their separate LLCs into a REIT. Um, and I mean, I just think there's like some pretty big conflicts in those discussions um, that require some attention. And I don't know how transparent some GPs have been. And just to be clear, like the reason why I'm mentioning it, it's not cool. I would call it more like unique. You know what I'm
Yeah.
saying? Like, and some
Unfortunately, I
of
think it's not as unique as you think, because I see it.
Yeah, I mean, yeah. I think it's unique in that it's generally only done. It's really only an option if you have like a decent sized portfolio. Generally,
Yeah.
otherwise, like it's hard to get institutional lenders and bankers to like look at this stuff.
Yeah.
But the problem is um, those are also the cases where you're dealing with the most number of LPs. And if you take a cross section of those LPs, they also, I would say, generally tend to be the less sophisticated type.
Yeah.
And so when you send them an update like this, they just have no idea how to understand it.
Can they even
They're
do
just like,
anything
oh,
about it, Alexei?
that's a whole other topic.
It's like I
um,
like their
yeah,
understanding maybe
yeah,
maybe moot. So
yeah. But to answer your question, many times they can't. But I would also say that sometimes the GP is like kind of in murky territory.
yeah,
Meaning it might be allowed by the agreement, but it's bordering on like unethical, you know?
I want to I want to make a point, and I want you to co-endorse it. A G and I want you to do it preemptively. I want you to endorse it before I even say it. No, look.
Before I know what you're gonna
Yeah,
say, okay,
yeah,
deal.
yeah. That was easy. That was easy.
I endorse it.
That that you're my kind of guest. Um, I I think it's very, very, very important. If a GP comes and says, listen, we're fire selling it or we're giving it back to the lender, this is not the sign of a bad GP. This is very often the sign of a good, ethical, honest GP. And I think those GPs that over communicate, that share the good and the bad, that give back deals when it's time to give back a deal, are the ones that are going to be the best performers in the next cycle, and that you should be looking at their next incremental deal. If you believe, all the pillars and everything else. As an LP, when I made my investments and whatever things I've invested in, I understand, and I may be more sophisticated, but I understand my upside, my downside, and my possibility of having a complete L. And I
Yep.
absolutely am more impressed. I'm even more impressed with the GP that over communicates and fails on a deal than the one that gets close to targets, right?
Yep.
Because it is harder to be high integrity, and transparent. When as a GP, you're heartbroken, you've bought family into the deal, you're in the deal yourself, and it didn't work out. This is so anyway, I'm enthusiastically, I want to say
Yeah, yeah.
that a failed deal is not the sign of a bad GP.
Absolutely true. And I'll tell you two different things. Um, First of all, I would point people to the seventh podcast on my site, which is it's lplessons.co slash
You're
podcast.
plugging. You're not
Um,
supposed to plug in the middle. It's a plug at the
no, no,
end.
no. So I'll tell you why. So I
I'm kidding.
literally
I'm
just
teasing you.
recorded this yesterday. No, I recorded this yesterday, and I'm going to tell you why it's relevant. So this is an LP that he invested in an office deal in 2019. And as we all know, like by the way, phenomenal location. Like it grew massively. In terms of like population during COVID and all that stuff. So like all the thesis was pretty solid. The problem is it was office. And
Yeah.
even though it was like fairly new office, um, COVID sucked, right?
Yeah.
And so they barely survived during COVID, and all these things happened, and they tried to, raise occupancy again and bring in new tenants. At some point, they had to pause distributions, which I think was the right of them to do. Um, and and eventually, guess what? Like January of 2022 hits, and they're like, oh snap, like now interest rates, right? And basically fast forward to like about a month ago, he got a notification that they got foreclosed on and they lost the whole thing. He lost the whole investment. And one of my questions to him was, did they do a capital call? Right? A natural thing, like, well, why not? Like maybe you could have saved it. And he said no. And one of the interesting things is exactly what you're bringing up, Blake. There's sort of like two kinds of GPs. It's not so binary. Obviously, all of these discussions are like sensitivity tables. You never know what's going to happen, et cetera, et
Yeah.
cetera. But there are deals that have a probabilistic chance of being saved, right? And there are deals that are so far in the red that they just basically can't be saved. And
Yeah.
on those, on the latter, that's what you're describing. Meaning, I would just add a little bit to your point is like if a GP can thoroughly explain, like, here's what was in front of us. We had two choices. We could bring outside capital, we could bring your capital, or we could just, cut it off. And here's why the first two choices didn't make any sense. And we just decided to cut it off. And like
Yeah.
we take responsibility for it, et cetera, et cetera, et cetera. I agree. Like that is, I mean, infinitely times better than the
Yeah.
GP that sits there and be like, well, I don't know, like let me kick the can down the road and hopefully it works in a few years. And in the meantime, I don't have to like default on a loan,
Yeah.
right? That's extremely important.
Yeah.
Um, yeah, I think people don't appreciate it enough. And the second thing I'll say is, at some point I reviewed a GP track record. I'm not going to say the name, but like they've been around for like 30-ish years. Um, and First of all, it's just parenthetically, um, I find it amazing. Like when you ask a newer GP for a track record, and they're like, "Oh yeah, like I don't know, like we don't share it publicly. Like maybe you can call me." And I'm always like, what are you doing? Like, and the next call I have with another LP is like a GP has been around for 30 years, and I'm getting to my point in a second. Like, I ask for a track record, it comes back in like 15 seconds. Like, here's the full track record from like 1970 or whatever. Here's every single deal, every single property address, every single multiple, and you look through it, Blake, and guess what? There's losses there,
Yeah.
right? Which is so important for GPs to remember that like investing is pretty hard. Like
Yeah.
sometimes you will lose. LPs need to remember sometimes you'll be the LP in that deal. So you only need to you can only invest what you can potentially lose, right? But in a sense, I just I also I think this is very encouraging from the perspective of a GP. Like it's very easy to think like, man, like if I have one default, it's over for me. I just don't think that's true.
Right.
Like I think
It's
I
part
think
of
it's
the
over for
game.
you. Yeah, I think it's over for you if you start being like not transparent, and that gets out in the marketplace. And like I think those situations are much worse.
I think I believe the character reference is the biggest bogey. I think that, like, if I'm looking at a GP or a deal, it's the character. I'd be much more concerned if I saw a track record of 30 years and every deal was 23%, 23% IRR, than some highs, some lows, some wins, some losses.
Right.
And yeah, okay. One more question.
Yep.
And then you could do another plug. Um, what? So you're looking at a deal, and it checks all the boxes. Sick GPs, like fabulous.
Very rare, but continue.
Fabulous GP, deep alignment, all the metrics look great, right? So the assumptions, everything is like, well, let me pull out the assumptions. Perfect GP, perfect alignment, and the deal paper is great. Which what would you not touch no matter what? Whether it's a location or an asset class, you've got $100 million. Where would you absolutely not put your money? I will absolutely not invest in an office in New York, even if there's a 30% IRR from a superstar with reasonable assumptions. Like, what's your thing that you just won't touch it?
I mean, I don't know if you're gonna like the answer, but I don't think about investments that way. Like, and I think this is an interesting discussion, Blake, because like, I mean, the way that I was trained is, um, a deal will make sense eventually at some price,
Yes,
right? Um,
yes,
and so I think that's an interesting thing for LPs just to understand. Like, at some price, things become cheap to the point where it'll make sense for you, right? Now, if you were to ask me like what macro theme sort of gets me really worried right now, I'll tell you, like, in particular, like states that, I mean, the macro theme that makes me worried right
yeah,
now, that has like a massive impact on multifamily valuations, is like what I would call marginal rent control. So in other words, not any, like, there's rent control in several places already. Obviously, it's already there. The legislation is in effect, etc., for years and for decades. Um, and it's not what I'm talking about. Like, leave that aside. I'm talking about like areas where there is no rent control, and the even like the speaking about marginal legislature that would put rent control into effect in some sort of region or city, um, I think will have outsized impacts on valuations. I mean, because from if you're holding a property that might be impacted, like, you as a buyer will sort of have to price in the probability of such a legislation passing and
yeah.
impacting the valuation going forward. And obviously, needless to say, if something actually passes, then it's even more severe, right? So that's something, directionally speaking, that I definitely think about. But going back to your actual question, like, I don't know. I mean, I've seen, um I've seen deals that are extremely, let's call them noisy, messy. But at some like insane price point, they start making sense, you know?
Absolutely. Look, so it's funny. I agree with all of it. I'm just going to build on it a little bit. So I always joke that if I get a spaghetti factory at the right price, I'll get into the spaghetti business. You can make money on anything. And everything is just a function of price, truly, right? I agree. In an absolutist kind of sense.
Yep.
But if we zoom in like a little bit to something that's maybe not super duper long tail, right? Like where I could buy a building for $1, like, okay, I'll buy the building. So if I'm out of like if I'm outside of the far ends of the bell curve, I might say something very similar to you on the macro side, which is that my concerns are probably more political than anything. So all things equal, I'm very unlikely to invest in multifamily in Chicago or California. Could be a great deal.
Mhm.
Even actually, I'm probably like very skeptical of. I'm just skeptical of the state of California, um, and
Right.
it would
You're
have to
saying
be
even if it is super cheap.
even if it's super cheap, it would have to be
Yeah.
like very deep down the bell curve. It would have to be like a long tail price to get me to take that risk because
Yeah.
because for me I have like very deep concern,
Yeah.
about that trend there, which is sad to say because it's the biggest economy in America. But you know, I would be very surprised if it was forward looking for the next decade. But then again, like, I'm just being super speculative here, right? Like, I hope
Right.
nobody's listening to me. This is not investment advice. California is one of the greatest markets on earth. We've got clients and GPs and LPs invest in California. California is great. I'm just a Floridian. It's a red state. Everybody like, I nobody taxes me. I'm biased. All right. All right. All
You
right.
just want everyone to move to Florida. Just say it.
Come. I mean, we've got way too many New Yorkers here. I'm born. I'm from New York. Whatever. Texas got all the Californians. All right. So Aleksey, give like a big, like crazy plug for where people can find you, listen to you, read from you,
Sure.
like pay you for services. Where can you be found?
Yeah, I mean, so I write usually daily on a bunch of like LP topics on Twitter and LinkedIn. I mean, my name is pretty unique, so I think people will find me. In terms of writing, I write to I think it's 4,700 LPs as of this morning, on lplessons.co. Um, and you can just sign up there. You just put in your email and like you just get my updates basically. And if anyone wants to get in touch with me, it's Alexey at hey.com. So Aleksey at
Aleksey,
hey.com, and you can just reach out.
Aleksey. I've been calling you Aleksey
Yeah,
the whole time. There's no correction.
it's normal. It's still 99th percentile.
I'll take it. I don't normally plug, but for the context of what we're talking about, we're about to launch or just launched, depending on when you're listening to this, Janover Engage, which is engage.janover.co. And we will be listing what I hope are, and it's not investment advice, those are Reg D 506C deals, but deals that GPs are raising for, as a place where LPs can hopefully shop deals, look, analyze, and hopefully pick some winners. So Alexei, I'll send it to you so you can check it out. I'd love your feedback.
Yeah, for sure. Yeah.
Um, this was fun. Thank you for playing with me. Hopefully we
This
could
was
do this
fun.
again sometime soon.
Yeah, for sure. Thank you so much for taking the time.
All right.